and get those out to you guys. All right, so income tax today, same thing as the other weeks. Let's just spend about an hour and 15 minutes doing income tax related things. Any questions come up along the way, then let's address those. First things first, income tax system. When you're thinking about it, you're also going to think about, let's get this out of the way 1 second. There we go. We're also going to think about the two other taxing systems that you guys have learned about at this point. Obviously, all of you are, what the way you talk, depending on when you're taking the exam, more or less, believe it or not, a month to 5 weeks away, 4 to 6 weeks away, depending on where you fall in the exam, what date that you have. All right, now income tax, if there's anything that I hear from students, this is the topic that gives most of you fits. And even those of you who are CPAs even have a difficult time with income tax. It's not similar to the CPA exam. And, CPAs are working probably like others in the real world. And now we have to take this book stuff and convert it into knowledge, or we have to take real life examples or real life experience and then convert that into a correct answer on the exam. So sometimes the CPAs have a hard time with this stuff. But anyway, when we're looking at the income tax system itself, it is part of the three major income tax systems that we have. And let's just really think about it, that we really just have three income tax systems. We have the income tax system itself, or I should say we only have three taxing systems, excuse me. We have income tax system, gift and estate tax system, which is a unified system. Okay, right? Like if I give away $5 million in gifts, lifetime gifts, then I only have roughly another $6.5 million ballpark left to give as a bequest, as a death time gift. All right, or I can be worth that much. I can only be worth whatever the balance is at my death. Anything above and beyond that, I get the estate tax and that nice 40% chop. But that's why you got CPAs and attorneys and advisors. They get paid well to help people avoid those taxes. And then we have the generation skipping transfer tax system. Now, if you are struggling with this topic in general with taxes, which I know probably everybody is to some degree or another, just take a look at how all these systems work. First off, we're going to have a gross figure on something. On the income tax system, we're talking about gross income. On the gift and estate tax system, on the year, we're talking about the gross gift, or we're talking about, let me just admit somebody 1 second. There we go. On the gift and estate tax side, we're talking, or on the estate tax, we're talking about the gross estate. And then on the generation skipping transfer tax side, it's the same thing. We're talking about the gross, the gross gift or the gross estate. All right. So line number one for all of these, or area number one, is going to be your gross stuff. Number two, then what do we have? Actually, let's do this. Color code this stuff. Then what do we have going on? Well, in the income tax system, after we add up all of our income, after we add up all of our gross estate, our gross gifts for the year, or any gifts that we've given to a skip person, someone that we've skipped down to, like a grandkid, and we have adjustments that we make. Okay, so with the income tax system, which we'll focus on today, the adjustments fall into three categories, right? Like HER. So you got like health here, health related. You've got education related expenses, and of course you'll have to memorize these, and then retirement. me try to change a setting, guys, just so everybody can come in without me letting them in. It's probably too late for that. That's okay. Just so I don't have to keep stopping. And then let's go with, continue with that. We have adjustments. And then what do we have? We have deductions. Here are deductions. Okay. And on the income tax side, that's either going to be your itemized deductions, which you have to know. You know, these would be like your charitable stuff. Charitable. You've got your SALT deductions if you're itemizing, so on and so forth. Those the things that the little things that you guys have to know. And then what we get to, in one form or another, you know, we get to basically we're going to get to you know, a taxable income, or the taxable gift, or the taxable estate. Taxable income, taxable estate, taxable gift, taxable generation skipping transfer tax amount, whatever it is. And then after that, we get our credits. Let's put that in green because we like credits, if we have any. And then at the end of the day, we either owe taxes or taxes are owed to us. All right, so hopefully that helps you, and it's just a simple little way to look at this stuff. Hopefully it helps you guys understand that these topics definitely are connected, and if we can relate to these topics as much as possible, makes things a little bit easier. All right, so those are our three taxing systems. We have those three separate and distinct systems. The first slide that we'll go over today is just a reminder. You have to know everything that there is about your American Opportunity Tax and your lifetime tax credit and your lifetime learning tax credit or lifetime learning credit. Know the differences, who's eligible, for how long are they eligible, and we may have covered that even in general principles, but your specifically your college related credits, your college related loans, Iraq and Afghanistan loan, your it just escapes me right now, but your other types of education funding topics, you're going to know those top to bottom. Why? Because, well, if I put myself in the mind of the board is saying, you know what, you know, I don't know what percentage, but say a good deal of American kids go to college. That means a good deal of parents of these kids are concerned or have to work through the FAFSA form, looking at the expected family contribution. And most families that send their kids to school are going to be interested at least in the AOTC and the LLC and in our various loans that are available. All right, so who qualifies and so on. We're also going to differentiate between our, or not differentiate, but know how to get to the self-employment tax and then the deductible portion of the self-employment tax. And the deductible portion of the self-employment tax is, you know, it's half of what that business owner is paying, you know, but remember, you as a self-employed person are paying 7.65% of your income, and there is a cap there, at least for the Social Security portion of OASDI. Right? As self-employed person, like I'm paying 7.65% as an employer, and I am my own employee. So I, as an employee, am also paying 7.65%. Now, if you think about like your KEO plan contributions, KEO plan contribution calculations, first thing that you do is you're going to subtract, or you're going to multiply our net Schedule C by 92.35%. Well, what's 92.35%? It's 100% minus the 7.65. Okay, and if you want to think about it in this way, it's like you're getting a tax deduction up front, Okay, because you're going to pay self-employment taxes, but you're not going to pay self-employment taxes on income that you're already getting taxed on. There's no double taxation. Okay, so if you're wondering about the Keogh plan, why we'd strip away 7.65 right off the top, once we get to our net Schedule C income, well, that's the reason. Okay. And you guys have maybe seen this trick before, and it works right up to the Social Security taxable wage base. If I have net Schedule C of 100 grand, I can just take $100,000, multiply it times 0.1413, and I get to my self-employment taxes of 14,130. Okay, instead of 515.3. Again, you get kind of a tax deduction here on the amount that you're paying for the employee, which for a self-employed person, the employer and the employee are the same person. Okay, but we have to pay on both ends there. And then the deductible portion of this self-employment tax is exactly half of it. Okay, so we can run that, we can use that little shortcut up to the wage base of 142,800. Above that, it gets a little bit more complicated. All right, now the different tax schedules. So I know like your A, C, E, what the K1 is for, your 1099-R, things like that. We won't go over those. I just want to point those out to you that you might see a question on the board exam, or I heard that they have asked that before. I can't remember if they asked that of me when I took it, but I'm sure that they did. Okay, so now let's look at next topic. Whoops. Let's go here. All right, there's also, so what a lot of people ask me about, a lot of students, is that, like section 1231, I kind of don't understand what's going on, but I think I can make my way through a question maybe, but let's not leave it to chance. And let me just clarify what 1231 is for you guys. It is exactly what it says right here. And you want to remember this in order to help you answer the question correctly. We're looking at depreciable real or personal property we're using in a trade or business held for more than 1 year. So anytime that you guys hear more than 1 year, what we're automatically going to think about is, I think I've got long-term capital gain treatment coming my way, either 15 or 20%. By the way, while we're on the topic of capital gains and tax rates, we can argue that there are actually 5 capital gains rates. All right, or we can think about it this way at least. We can say that 0 is, if your AGI, I think, is under somewhere in the mid 40s or so, might be higher than that. But let's just say if your income is fairly low, then you're not going to have any capital gains tax, or we'll have most people fall into the 15% bracket, less people in the 20% bracket. There's also something here at the 25% bracket, and then also something at the 28. The 28% and the 25% brackets are, it's not an absolute number. That's just a cap. So that is the reason why when they give you a tax rate, you guys have to be mindful of why they're actually giving this tax rate. Is it are they just trying to throw me off? Possibly. More often than not, they're giving us that tax rate for a good reason. All right. So these are our 5 capital gains rates that we want to pay attention to. And we'll cross these two, of course. I think we're actually going to cross this 25% one in a second or in a few minutes. But back to this 1231, some of you have seen me draw this out, is that we're going to assume that like 1231 is the ruler of sections 1245 and 1250. And we'll see also in a minute why it is on some questions that you've seen in your Q banks is that they'll ask about the nature and the amount of the gain. So what are they talking about with the nature of the gain? A gain is just a gain. Well, not really. The gain can be categorized and taxed in a couple of different ways. All right. Now, if I go and sell a property, I might have Section 1231 gain, and I might have Section 1250 gain. By the way, this Section 1231 is the best of both worlds, because on the upside, I get long-term capital gain treatment on a gain. On a loss, I get to actually take that loss against my ordinary income, which if I'm in a higher tax bracket or a bracket that's higher than 15 or 20%, then I really make out well, okay, because I can take that loss against that higher tax rate. If I have a gain and maybe I'm in the top tax bracket or even in the 24% tax bracket, I'll be taxed at a max rate on a gain of 15%. Okay, now why'd I say that's why I mentioned 1231, somewhat rules over these guys, because you'll see that these guys are going to have some, could have some less favorable tax consequences, usually that they do. Now, 1250 property, we're typically talking about rental real estate. And I always like to say that your 1245 property, because it's a smaller number, the smaller things that could fit into the rental real estate property are 1245. Okay, your boilers, machinery, desks, chairs, stuff like that. Okay, that's a chair. Here's a desk. Why not? Since I mentioned it, let's just draw out a boiler here. There's our water boiler, or it looks like a beer can, but whatever. Okay, so 1250, bigger number. Real estate is usually, or has to be bigger than the stuff that we put that can fit into that real estate. So now what's our rules on the sale or disposition? Let's just say the rules on the sale. First of all, we have ordinary income tax to the extent of the depreciation previously taken. So remember what depreciation, if you want to put a little bit of color, let's say, into the explanation or the understanding of depreciation, that depreciation is a loan from we, the taxpayers, to you, the real estate investor, or the business owner. Okay. Well, the reason I say that it's a loan is that because when you go and sell that property for which we gave you a depreciation deduction, we let you skip out on your income taxes temporarily. When you go and sell that thing, I don't care when it is, 50 years later, we need that depreciation back from you. And that's fine. That's part of that's the name of the game. That's why you get so many people love to invest in real estate. Primarily, the number one reason people love to invest in real estate is that the leverage, no question about it. I can go out and buy $1 million property, and if it's for my own use or it's a business use, it's a different story. But let's say I can go out there and just put down $200,000. I can control a $200,000 property, $1 million property with just $200,000. And if that thing goes up in value 10%, I've already made 50% on my money. Okay, so and now the leverage works the other way as well, just like in our margin discussion. Yeah.
Hey, quick question. This
Sure.
section 1231 is MACRS, right?
Okay, so you're talking about accelerated cost recovery system.
Yeah, I cannot find the term section 1231 anywhere on my book. And this 1245 and 1250 is under MACRS, but it doesn't refer to it as section 1231. So that's what's throwing me off. That's all.
Which book are you using? That's weird.
Danko stuff.
Okay. Yeah, but you're looking at Danko's, I think, review books. I don't, and I mean, I actually have those, but
yeah, I mean, I also looked it up on SAN and I couldn't find section 1231.
That's
But it's
kind of,
listed under macros, but I mean, see, sounds like the same concept. I just wanted to make sure that,
yeah.
we're talking the same thing.
Well, you were definitely talking the same thing. And I'm just wondering if they have, yeah, like in the books that I have, they're usually piled up right next to each other. But just remember that this guy right here, he kind of rules the day. But that'll become more clear once we see an example. But in order for him to rule the day, he does have to wait his turn. And again, when we look at an example here in a second, that'll make more sense. So back to the depreciation just for a second. And our depreciation, again, is just a loan from the taxpayers. It's got to be paid back. Now, a property sold at a gain is going to get capital gain treatment. And we also have a property that's sold at a loss is going to get ordinary tax treatment. When it's 1231 property, we don't have these handcuffs on with the $3,000 for married filing jointly. They could sneak a question in on you on the 5-year look back rule. Let's not confuse that with the 5-year look back rule on Medicare, which I believe that we talked about a few weeks ago in the insurance discussion. But if we have any capital gains, one second, Luis, I think most people are using Danko. And maybe there's a reason he doesn't have it in there. I don't know, or if it's maybe in a different section. I'm not too sure, Luis. Yeah, live review book. I mean, I actually somebody gave me that set, which was nice of them. But I'll look today, Luis. Let me see what I can find out. Remember that five-year look back rule? Okay, so if we have capital gains this year, we're going to actually treat those capital gains as ordinary income taxes. And that is going to be exactly to the extent that we actually had 1231 losses in the last 5 years. Why? Because the IRS doesn't want us gaming the system. That's why. All right, there's a comment here. Let me see. Dalton. Okay, Carrie. Yeah, and is it in the Dalton book, Carrie? I believe so. I can tell you 100% it's in the Kaplan books. If it's in the Kaplan books, I will also guarantee you that that's going to be in the Dalton book. Okay, since you get some crossover, that happens, and some of that information follows over to competing companies. That sort of thing happens. Okay, but anyway, so that's going to be your 1231. I would study up on it and your 1245, but better than studying up on it on your own, let's look at a 1231 property question just in a second. Now, 1250 I talked about. There's a couple things that I'll point out in here. 1250 property. Remember, this is the actual real estate, like the rental property. Let's just use rental property as an example. Okay. This part's important. And you'll notice I'm slowing down a little bit on 1245, 1231, and 1250, because of all the topics in income tax, this is going to be in the top 3 things that are the most misunderstood. And for good reason. But hopefully I can provide some clarity, or I'm pretty sure I can provide some clarity here for you. So we're going to have a partial recapture, and it's called something else, which we'll see. We're going to have a gain on the sale, but up to a maximum rate of 25%. And then anything above and beyond our original basis, we're going to get clipped at that 1231 rate, which is going to be our long-term capital gain rate of 0, 15, or 20%. If we do have a loss, then we can get to actually treat that as a 1231 loss. So that's why I can say that, that I own a 1250 property, and when I sold it yesterday, I took a loss on it, and it was a 1231 loss. Or that's why I can say I own a property, and when I sold it yesterday, I actually had a 1250 gain, and I actually had, or I should say that 1250 property was treated as a 1231 gain. That's why. Just keep picturing that 1231 is the king of the hill. He's sitting up there, kind of looking down at 1245 and 50. So, I'll help you out. I'm going to give you some better rates here, but you're going to have to get clipped at the 45 or the 50 rate first. The tax, our section 1250 property rate is progressive. Okay, and it's a good point here. Portion of the gain may be taxed at the 0% rate all the way on up to 25%. So if I'm in the 32% tax bracket on a question, they are telling you that for a specific reason, they want you to think that that gain is taxed at 32%. All right, now we finally get to our question. So now we've got, let's look at the last sentence first. We want to know what is the amount and the nature of the gain on the sale. Well, we don't know anything about the question yet, obviously. And the reason I say that, sometimes that we can actually look at a question and for the most part, figure out what they're trying to ask. That's very few and far between. So let's look at our buddy here, Aris. Aris owned a rental property. When you read the words rental property right out of the gate here, you're going to be thinking about a couple of things. Now, a couple of these things might not even have anything to do with this question. I know they won't have anything to do with their question. But when you hear rental property, your ears are going to perk up, and number one, you're going to think of 1231, 1245, 1250 property tax rules. You're also going to think of, and this has nothing to do with this question, use related, use unrelated property. These are the properties like, Luis lives in the East Coast. Luis, I think you're in the East. Yeah, I'm pretty sure you're in the East Coast. For some reason, I think Virginia.
Atlanta.
Oh, that's right. Okay, Atlanta. So Luis lives in Atlanta, but he's got a place down in Florida. Oh no, you guys in Atlanta don't go down to Florida, do you? In the winter, it doesn't even get cold.
Oh, heck yeah! It's the closest ocean we have.
Oh my, it's hot in Atlanta. We go down in Chicago. Let's say Luis is in Chicago. That's even better.
Just a little bit.
Yeah, so he's in Chicago, but he goes down to Disney World. I don't know, for a few days. He's got a condo down there, and if he uses it for exactly 2 weeks, then is this primarily rental use? Is it use related, use unrelated? Primarily rental use, I should say, or is it mixed use? That's what I think. That's what I was trying to write here. Primarily. Is it primarily rental? Is it personal? Okay, is it mixed use? And then we've got those rules that you'll have to know, about the 14 days and then 10% of the days that the renters were in there. And if we have expenses and the renters were only in there for 300 days out of the 365, that only that portion is deductible. Okay, so brush up on those rules, what I'm trying to say. But anytime you see rental property, you're going to also think about your passive activity loss rules. And we're going to remember that we have really 3 types of income, because you've got passive, you've got active, and then you've got portfolio. And I just like to think of it as, PAP, personal auto policy, has nothing to do with passive activity losses, other than that's what rings a bell. And then you're also going to think about a phase out, and we'll actually see a question on a phase out coming up in a second. Loss phase out. But anyway, so Aris owns a rental property. He bought it years ago for $300,000. Now, he bought it years ago. What we're automatically thinking right now is that it's 1231 property, because this looks to me to be tangible personal property or real estate that we use in a trade or business, and we've held it for more than 1 year, more than 365 days. He used the straight line method of cost recovery, which totaled 60 grand. By the way, we're depreciating this property over 27 and a half years. And then he sold the property recently for 350 grand. I say turned a nice profit. What's the amount and the nature of the gain on the sale? Okay, so how are we going to attack these questions? We look at it this way. First of all, Aris bought this place for 300,000, and just off to the side, why don't we just put down that this is his, let's just call it his original basis. Yeah, it's his original basis. That's what he put down for it. Remember what goes into the basis, by the way? Any brokerage costs, taxes, licenses, fees, all that stuff. Anything that it took me to actually buy that place. Now, what's Ari's doing over the years? He is going to actually take depreciation deductions, which again are loans from we the taxpayers. When I say it that way, it reminds you that what this guy did, what did he get in? 60 grand. Okay, so he took 60 grand in depreciation deductions. Now, normally when we're subtracting something, you want to put it in red, but in this case, I'm subtracting it, and we're going to wind up with an adjusted basis. Oh, let's put this new adjusted basis, I don't know, in orange, just to differentiate it. 240,000, excuse me. Here's the 240 grand. And the reason I put this in green, because he's paying his income is 60,000 worth of his income, from whatever other sources, is not being taxed. Remember, it's a loan from the taxpayers. So now we come down to his adjusted basis. Here's our adjusted basis. Okay. Actually, no need for quotes, but who cares? Now he turns around many years later, he's going to sell this place. And the way that I just think about it is, here's my original basis. Here are the depreciation deductions that I took, which were lowering my basis year after year. And that's the IRS's way of ensuring that when I go and sell this place, that I'm going to pay back all of the tax deductions that I was granted from the taxpayers. All right, fair enough, but that's just how they do it. 240,000. Everything that takes me in my sale all the way up to 300,000 is going to be a section 1250. Let's just put it this way. Over here, we're going to have section 1250 unrecaptured 1250 income. Okay, now this is a income tax recapture, but it's called unrecaptured 1250 income. And why it's called that, I usually know, but in this case I don't. Okay, so everything right up to there, that 60 grand that we the taxpayers gave you over the years, which was very generous of us, we need that back. Okay, now if you only sell this thing for 250 grand, fine, we're only going to recoup that 10 grand, but everything up to 3 grand we're going to recoup. He's in the 32% tax bracket, remember, but section 1250 max tax rate is 25%. So if they ask you on the exam, 60 grand of this is going to be taxed to you at a max rate of 25%. He is not in the highest tax bracket, and so he's going to be his 1231 rate now is going to be 15%. And what are we going to apply the 15% time? The 350 grand, excuse me, the 50,000 above and beyond his original basis. That's what he sold it for. Okay, so that's why in this case, what we're going to have is we're going to have 1231 on, we're going to have the section 1231 income tax treatment. Oh, let me erase that real fast so it looks a little bit nicer. 1231 rate will be applied towards 50,000. Okay, the amount from 300,000 of his original basis up to 350 grand, that profit, that difference there. And then we're going to have section 1250 unrecaptured income on the amount of depreciation deductions that he took over the years. So if I ask you what is the amount and the nature of the gain, the answer is going to be, it's actually going to be two figures right here. Okay. If they really want to get nasty with this type of question, which they possibly can, they'll also throw in something like Aris had a, he had some sort of lost 1231 property within the last 5 years. And that portion right here, which is treated as long-term capital gains, is going to be recaptured at ordinary income tax rates. Because again, they don't want you gaming the system. Jackie, your head is spinning. Okay, stop it from spinning, Jackie. I don't want you to hurt your neck.
So Sev, just to clarify that 1231, that 50,000 is the difference between 350 and 300.
Right. Yes. And for
Right.
them, yeah.
I knew that depreciation needs to be recaptured back.
Right.
Yeah, I don't think I've ever seen a question like this.
That's
just me.
Yeah, no, I'm sad. I'm surprised. Like these are this would be considered, I think, mid-range difficulty. Oh yeah, Carrie, what did I just say about losses? Okay. What I just said about losses is it's going to look a little bit messy, guys, but let's just go back here a second. Losses, no, that's not it. That's a 1231. Remember, Carrie and others, go back to your books and look at the 5-year 1231 look back rule. So that is if I actually have capital gain treatment, a 1231 treatment. So 1231 is just the code. When we're saying long-term capital gains, we're talking about 1231 of the code, section 1231 of the code. If I've got losses that I've taken deductions, 1231 deductions for in the last 5 years, remember 1231 is a pretty powerful section of the code because on the upside, I get long-term capital gain treatment on the upside, on a gain on the sale of a property. A loss on the sale of a property, I actually get to offset my income. And my income tax rate typically is higher than 15 or 20%. Okay, so I get a benefit on the way up on a gain, and I get a benefit on a loss as well. Okay, but to sum that up or make it a little bit easier, Carrie and others, just study, take about 20 minutes. That's probably all it'll take, maybe a half hour to read up on this 5-year look back rule. And again, we're not talking about the 5-year look back rule on Medicare. Yeah, a lot of crazy stuff in taxes. But you don't have to be a CPA or don't have to become one or study. We just have to pass the income tax portion of the exam, and we don't know what at the end of the day what that equates to a grade. But if we're given 10 questions on income tax, if we can hit 7 of those, we're on our way. Right? So don't stress too much. Okay, so that's your 1231 and 1245 and 1250. Jackie's head has stopped spinning by now, I hope. And let's look at, we got another A name. I wonder who these kids are. I just gave it away. I wonder who these people are. Alina is single. And it's bad grammar. Not bad grammar, but is employed and dabbles in real estate. This year her AGI will be 116,000, and she's going to have a $32,000 loss from her rental property that she actively participated in managing. How much if any of the passive activity loss can Alina deduct this year? What if she is married? What will happen then? Okay. You're going to look at somebody. Remember your passive activity loss rules. And remember, I also mentioned before, we have 3 types of income. Now, anytime I ask a student this, at this point on, you guys usually get this passive activity and portfolio. Okay. The rule is now that if you have passive activity losses, you can only offset passive activity income from passive activities. And why is that? Very briefly, maybe I'll explain this in like 20 seconds. Back in the day, I don't know when it started, but let's say in the late 70s up through like the mid 80s or so on, you actually had CPAs and attorneys that would take out ads in newspapers and would advertise, hey, invest 10 grand with us. And generally speaking, let's just say, or the general example, invest 10 grand with us and we'll get you 100 grand in tax deductions. Why? Because the highest income tax rates back then actually were very high. And I think at one point, like they neared 80%, but that's like way, 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 way up there, 70 or 80%. But anyway, so you got wealthy people or high income people would be like, okay, well, let's go invest a ton of money into oil and gas outfits or something. And if you put in 10 grand, we can get you 100 grand in losses. And then, that'll save you a lot of money. All right. So IRS, Congress put an end to that. Except for rental real estate. We want people to be incentivized to go out and buy real estate so people have a place to live and so on and so forth. So what the IRS grants is a $25,000 so-called corridor that I can take as a tax deduction against other income if I am a non-professional real estate investor. Okay, let's put this as 25 grand. So if I've got a job and I do real estate on the side and I have a loss, which is typically the case when you first buy a place, maybe you're rehabbing it or whatever, I can actually take this depreciation, or not, I can take this deduction against active and portfolio income. So so-called corridor. Of course, there's a cap on how much I can do, and whether I'm single or married, once I get above 150 grand in AGI, single or married, this all disappears. And it disappears because for every $2 that I go above this limit in AGI, we start chopping this away by $1, all the way down to 0, 2 for 1. It's a $1 reduction for every $2 above 100,000 in AGI I have. So you'll notice that once we get to AGI of 50 grand over the initial limit here, threshold, then $25,000 of this deduction is gone. It's out of there. Okay, so let's get back to Alina and what she's up to. Here's how I like to think about it when this threshold, by the way, they give this to you on your appendix G. I'm like 99.9% sure. I'm pretty certain. It actually says single or married on there. All right. Now, I like to think about it just like I mentioned the other week. The other week. When I've got a phase out threshold here between and the entire threshold amount is 50,000, right? 100,000, and we kind of run out of gas here at 50,000. I just look at this entire 50,000 and let's do something. And I like to say, all right, well, if you guys want me to, hold on, I'll get to your question in 1 second. If you're giving me like a phase out threshold, you must be doing this for some reason. Now she's like 16,000 into this threshold. So I imagine what's going to happen if I'm 16 grand into this thing. I mean, I can kind of do the math quickly, but if you're on the exam and you've got 10 different ways to think about things, we can say, well, we're going to reduce this this $25,000 nice little gift that they're giving me by $8,000, or we can do this as like a percentage as well. Okay, just in case you're amped up on the exam, which you will be, especially in the beginning, and you get this question and you're like, oh, I can't remember this. Always just go back to the phase outs. So a couple ways we can do it. Just take 16,000 out of the 50, and that gives me 32%. That means I'm going to be, I won't be allowed to deduct against my active or passive income, excuse me, portfolio income from this passive activity, the 25 grand. I have to chop it by 32%. So 32 grand times 25,000 is $8,000. That means that 8 grand of this 25,000, it's no longer available to me. And if I subtract 8 grand from 25,000, I've got $17,000 that I can actually use as a deduction against active and portfolio income. Now she's got a $32,000 loss. That is another, what, 15 grand that Alina can then carry forward really indefinitely until she sells the place, and she can use any accumulated loss that's been built up over the years. She can use that to offset any gain that she will have. All right, so this is our this touches on the passive activity loss deduction. So do you guys have any questions here? Actually, there was a question that came in. While you guys are thinking of any other questions, let me know. Yeah, that's right. Killian, if you have a pal, you need a pig. That's right. Passive income generators. I think that's what the pig part is. Passive activity loss, and you have a passive income, passive loss income generators. So is her income now, Todd, you're asking if is her income now $99,000? Yeah, it depends on, yeah, this is 116,000. We get to actually reduce that down to $99,000. Good call on that one. All right. Let's do a couple more, 1 or 2 more questions. So let's clear that out. And let's see what happened. Let's see what happens next. And we've got Judy, IRA phase out question. You gotta like these. Now this one I changed up a little bit today in preparation for our group here tonight. So let me see if I can get any of you to get this right here. I'll walk you through it, but let's look at the last question first. So how much of Mike's contribution is deductible? Now you're gonna probably figure out that this is fairly quickly. This is the IRA contribution deduction question. And we're gonna be, what you're gonna remind yourself of is that if I have a married couple, because the married couple is gonna be more difficult, and husband and wife are both working, probably what they're going to do to us is they're going to say either the husband or the wife, one of the two, is covered by a qualified plan and the other is not. All right. And why are they going to do that? Well, they can just say that they can use a single person as an example, but that's going to be a little bit too easy. Because with the married couple, we have we have a complexity there. So anyway, so we got Judy. She's an right out of the gate. She is an active participant. All right, Luis, you're saying Judy can't. All right, well, let's see. You're probably right. So Judy is an active participant in employer-sponsored retirement plan. I don't know if they'll sneak this in on you. Like if you've got a DC, defined contribution plan, if it's available to you and you opt out of it, you're not contributing, there are no contributions made by the employer, you're not benefiting at all, then you can be considered non-active. If you have a defined benefit plan, then that defined benefit plan, even if you opt out of it, you're still considered an active participant. All right, let's see what we got. A couple of questions, it looks like. And let's let Sharon in. Oh, did the names get mixed up? Hold on a second. Where's Arlene? Hold on. Here's Judy. Let me read through it and I'll fix it. They're combined 2020 Mike's portion of Judy's portion. How much of Arlene's? Okay, let's go with Judy. I was actually using the names of my old neighbors. And so anyway, so there we go. It's Judy. Arlene's out of the picture. Arlene was it was before we moved, our dear neighbor who was in her early 80s, sharp as a tack, and talked like a trucker. I mean, we loved her. We still do. She's still around. She's not going anywhere. But anyway. So anyway, combined AGI is 206,000 for the year. Mike's portion of their AGI is 111. Judy's portion is 95. They each contributed 6,000 to an IRA this year. How much of Judy's IRA contribution is deductible? And then how much of Mike's contribution is deductible? We don't care who brought in the income. The AGI is the AGI. So that's where I decided I'd get a little bit cute with you guys and try to throw that in, because you might be aware, and you can just look at your Appendix G, but you're aware that the person that is covered by, who's considered an active participant, has a phase out between 105 and 125. Let's separate that. And then the person that is not covered, but is married to somebody who's covered, their phase out is 198 to 208,000. Okay. That's why I said the complexity with the married couple, it's different. But again, we don't care that Mike contributed 111 to the household and Judy contributed 95,000 combined. Where are we at? 111. That's 206,000. And will that phase out be in the provide? Yeah, Carrie, that is on that Appendix G. Exactly. You don't have to remember it. Unfortunately, I had to remember it back when I took the exam. That was awful. All right, that was fantastic to have to remember that. And okay, so now we've got this combined AGI of 206,000. Automatically, we should see that Judy, while she, yes, definitely can contribute $6,000 to an IRA, there's no problem there. She just can't deduct any of it. Mike, while we can see that that he's just going to come in at the top end of the threshold. Now, how do I deal with the thresholds again? You guys might have your own system. I just like looking at what's the total difference here. And I use that as my denominator. And I just think of, hey, once I cross over this 198,000, I'm getting into this like danger zone area where something bad is going to happen. And, by what amount are we into this so-called danger zone? Well, their AGI is 206. The bottom end of this threshold is 198. And we're 8,000 into this thing. Okay, so let's put 8,000 into this thing. That, of course, 8,000 divided by 10 is 80%. And when we're doing ratios like this, remember when I said back in week 1 or 2, when we're doing ratios, we're always excluding something. Well, so what can we exclude here? We're going to exclude the ability of Mike to deduct the entire $6,000. In fact, he's going to be able to not use 80% of that $6,000. That should be 4,200. So 4,800. So how much of Mike's contribution is deductible? Well, he can contribute $6,000, but he cannot deduct 4,800 of it. Therefore, he can deduct 1,200. And that's going to be a $6,000 contribution. No, Luis, he is forbidden. He cannot deduct 4,800. And yeah, I think Luis, if you were here a couple weeks ago, it'd be impossible for you to remember. But what I mentioned is that anytime we're doing a ratio like this, okay, or we're excluding something, we're always going to be wanting to excluding something, like an annuity payment. We have the exclusion ratio. There was an example I gave a couple weeks ago about something else where, what the real estate, not the real estate, it is if you don't have a certain amount of coverage, like the actual certain amount of coverage on your real estate, okay, and then if we have a partial loss, that we're dealing with something that we're excluding from coverage. Everything when we're doing ratios, we want to exclude. So that you just, or you want to think about it, if you do a ratio, that you're always going to do it as if you're including something. I don't care which lane that you take. I always just do excluding. Okay. All right. Now also watch out on the exam, because what they're going to do, because they're a little bit tricky with some of these things, they're not going to say, they each contributed $6,000. They're going to say, Mike, he contributed 5,300, and then Judy over here did like $400 or something. And they're gonna put both of them. They're gonna put their AGI at an amount that's between 105 and 125. So both of them can take a deduction. And you're gonna, in whatever that exclusion amount is, you're gonna multiply it times what they contributed. Okay, you can't do that. What we're excluding is a portion of the $6,000 IRA maximum or $7,000 IRA maximum. So if these two were 50 or over, we'd actually use $7,000 here, and they would not be able to deduct 80% of the $7,000. Okay, let's see. I think, yeah, that's actually all I prepared for you guys today. Like I said, I didn't get any questions or anything like that, or requests to do any topics. So let me see if you guys have any. Yep, Killian, you got it. Yeah, I definitely appreciate it. Also, we're gonna do next week. Let me just double check. I believe I wanted to squeeze in 1 week. And if you guys don't mind, you're going to get an email on this. And if it's, if it bothers you or whatever, just unsubscribe. But I'm going to do a 2-day. It's actually like a 2-evening class. That's a paid class, and it's advertised as 3 hours. But we really do 4 hours each night. And I do it specifically or strategically a week before the exam, where we get into just the toughest topics, and you guys send in to me what you want. But you'll probably get like 3 emails on that just as reminders. But like I said, if it bothers you, just unsubscribe. No, wait a second. Yeah, that is on the 28th and then the 1st of March. So we will have a state perfect. That actually works out perfectly. We're going to do estate planning next week. And then what we'll do on the 21st, I'm just peeking at my calendar here. Yeah, what we'll do on the 21st is why don't we run through a case study, or I can leave it up to you guys where you send in your questions to me throughout the week, and then we tackle those just like in here. Luis, if you are over 50, you can do an additional $1,000. Right. You can always contribute. Elon Musk can contribute $6,000. Bill Gates can do $7,000 to an IRA. They just can't deduct. That's all. But yeah, let's do. No, sorry, 1 second. You guys have to remind me, we did not did we do investments? For some reason, I don't think that we did. Yeah, Jackie, tax fell. Okay, Yanni, tax fell from 14 to 12. And Jackie, you probably know why that is. Behavioral finance. They had to make some, yeah. So let's do this. We will do investments next week. We will do estate planning. But those will be the final 2 weeks because I have that course on Monday and Tuesday, the last Monday of February and the first Tuesday of March. Okay, but that should be sufficient for you guys. Send in some questions to me over the next week or so on any investment related things. If I don't get any, we'll do like what we did today, whereas I'll pick out some of the toughest topics for you guys. Carrie, you missed most of last week. Can you access the recording somewhere? Yeah. I thought I heard we could, but can't see anything in my email. If you go to throw in pro exam tutors into YouTube, you should see it and it's labeled. Okay, see, Danko says, although it is now only 12%, the test still has a large amount of what he calls wrapper questions, which have a tax wrapper. Oh, yeah. Yeah, big time. Estate planning will have wrapper questions. Estate planning, like half of it is taxation, if not more. Right. Insurance. Right. Insurance, we have tax questions in there. Wrapper questions is a good way to explain it. Carrie, if you can't find that, also my email signature, you should be, if you just click that link, it takes you to the my YouTube page, which I did post last week. And then what I'm starting to do too is adding other topics as we go along. Yeah, is that what is? Okay, perfect. Thanks, Jackie. Jackie's head stopped spinning long enough to go to the to my YouTube page.
Yeah, that question was a mind bender. I'm glad to have behavioral finance in there as its own category to hopefully it's a little easier on the brain than some of these other ones. And I actually like taxes, but those, asset exchanges and the 10, 1231s and 1245 and 1250s, like,
Yeah, it's well, we're all wondering, Jackie, what's the matter with you? Because you just said you like taxes, but
I do. I guess when it comes to more personal taxes, like, going through the tax return, credits, deductions, all of those 1040 type things, retirement, what comes off of for AGI and from AGI, those things I'm good to go. So I guess that at least that lessens the area that I have to sort of do a workout on.
No, I got you. And it, you get into the details with 1245 and 1231 and 1250. And I always like bringing the history into it whenever it's appropriate, because then I'm all about painting pictures for you guys in your mind's eye, because it can be dull, it can be dry, but it is kind of cool when you look at like passive activity losses and how at risk rules apply first, and then passive activity loss rules apply second. Well, why is that? Well, because then I like to think of these, like these big Texas oilmen putting in these, what do you call the things? Oil drills, and putting those in and the cost that's associating with those. And then I like to think of like the slick advertisers or the CPAs and the attorneys that are taking out advertisements to say, hey, invest in this oil well over here because there's a ton of upstart costs and you've got a high tax, very, very high tax rate, and you can get great tax benefits. And then I imagine Congress coming along and being like, shaking their finger and like, oh, you guys can't really do that any longer. When that's how you get to your 1245, or that's how you get to your passive activity loss rules and at risk rules. So there's always like a story behind there. Amira, taxation affects everything in financial planning. Yes, for the most part, especially when you get to the higher net worth individuals. Yes, they do care about returns and all those things. But the higher in net worth that you'll notice your clients, the more interested they become in taxes. All right, cool. I think that does it. So yeah, next week let's work on investments. The final week, which makes sense to do estate planning, because that kind of wraps everything together. Yep, Jackie, you're welcome. Jackie's gonna curl up to a tax book tonight and and read up all about 1231 and 1245 and 1250. All right, any other questions? All right, well, I thank you guys for joining me tonight. Anything comes up during the week, just let me know. Yep, Carrie, you're welcome. And then, yeah, totally. If you're more than welcome. Would love to see you at the two-day class. That's I like to call my anti-anxiety class. The anxiety is there. After the class, maybe it's like down here a little bit more. And like I mentioned last week, a couple weeks ago, you probably can't swing a whole day to take off a day, but if we pick a day, close the book at 1 or 2 o'clock on a Sunday, because I imagine most of you are working. So give your brain a little bit of a break. It'll help you study. Yeah, Josh, I will send that out. Actually, you'll see that probably coming in the next handful of days. Yeah. And that session too, those 2 sessions are recorded. Those are for you guys. I would go through those, but they will be the toughest topics, as much as time allows, within each one of the modules. Yeah, so we'll see some of this stuff, but it's going to be amped up, that's for sure. Okay, and that's just so that we, if you guys are on the cusp, let's show the board a thing or two. If we're on the cusp, and then let's get right over it. And we're just going to aim for 71%. All right, even though we don't know if 70 is a passing score, but let's just pretend that it is. All right, that's all I have. I will I'm going to sign off. I will post this tonight. I'll work on getting the slides worked on, and then I will send those along too at some point. All right, everyone, thanks again. We'll see you next week. Take care.